The open answer to that is no. That's actually not why I wrote the book. This you'll probably laugh. I wrote the book in late 23, early 24. I was pretty bored. I was
Oh,
closing
really?
120, 150 transactions a year, really cruising right along, doing really well. And I had helped a ton of people that had built wealth, built investment properties, and had gotten tons of positive feedback over the years. And I had a lot of spare time on my hands. And I was like, maybe I'll write a book about how to pay off your loan and how to build wealth using your mortgage in your house.
Hello, everyone. Sergio Tifer here, and welcome back to Cracking the Code, the podcast where we uncover the strategies, mindset, and innovations helping real estate professionals grow stronger businesses and create lasting success. Today's guest brings a unique perspective to every realtor, investor, and homeowner can benefit from. Joe Massey has spent more than 2 decades in the mortgage industry, serving as a commercial lender, financial analysis, underwriter, and senior loan officer. Today, he leads Team Massey at Synergy One Lending, where he's helping clients and real estate professionals think differently about financing, not simply as a way to buy a home, but as a powerful strategy for building long term wealth. He's also the author of the Mortgage Escape Plan, where he shares practical strategies for paying off a mortgage years earlier while creating greater financial freedom. All right, let's dive into it. All right, Joe, thank you for joining. How you doing today, brother?
Outstanding. Really appreciate you guys inviting me. I'm excited to be here and just enjoy talking with folks, enjoy talking about mortgages, enjoy meeting new people. So thank you so much for the invitation.
No, absolutely. Off camera, I was telling you that I love the mortgage topic a lot. I feel that is a topic that many agent team leaders and in general real estate people do not understand very well.
Mm-hmm.
And I think it was about time to bring someone that can bring some clarity to this muddy world,
Oh,
which
thank
is
you.
mortgage rates and whatnot. So tell us a little bit about yourself. I mean, it seems like you've been in the business for over 20 years now. You started as a commercial lending, agent, and then now you're moving more into residential. But anyways, just
Yeah.
walk us through the process of you becoming a professional,
Yeah,
if you don't mind.
so I went to the Colorado School of Mines, which your audience may or may not be familiar with, but it's mostly an engineering and technical school here in Colorado, but they do have an economics degree. And my class was actually the second graduating class in economics. But I graduated right after 9/11. So I graduated December of
Oh
2001,
wow.
which was a tough time in the engineering and oil and petroleum world, which is really what my school is designed for. And so I had a tough time finding a job and had done some internships at some mortgage companies during the summers and reached out to my database and finally found a job in the mortgage business, working for a company that's no longer around called Aurora Loan Services. They've been swallowed up by Lehman Brothers and the Nation Star, and now Mr. Cooper. But that was my very first job in February of 2002. Learned a lot about financial analysis, then moved into doing some commercial underwriting and commercial financial analysis for a local bank here in Colorado, and really became a loan officer in 2004 on the residential side. And so ever since 2004, talk to people, talk to real estate agents, understand their finances. Can we help you buy? Can we help you refinance? Maybe you should sell. Maybe you should take cash out. Sometimes maybe you shouldn't do anything. Those are some of my favorite conversations when I do a review with folks and go through and say, you know what, you're in a great spot. Don't do anything. So a big part of what I do is just consulting, I guess, and just looking at people's
Right.
finances and saying, here's the good, the bad, and the ugly.
You lived through the 2008 crisis, which a lot of people like to call it 2008, but for me it was more 2010 crisis because that's when a lot of folks really felt it in 2010. How was that for you? I mean, how did that shape your entire professional career? I mean, you became a lender in 2004. You said you started in 2001. I mean, Jesus. I mean, you lived right through it, and you were right at the beginning of your career, right?
Yeah, 2008 was a challenge. I at the time had moved up to be a vice president of the company I worked for, Ace Mortgage Funding, and had moved to Philadelphia to run a branch out there, and was doing well. And then all of a sudden, things were not going well. And what I learned, and this is actually something I wrote down in my notes, is that taught me to live below my means. I got out unscathed. I never missed a payment, never had a foreclosure, never had any of the negative things that happen to a lot of folks, but I saw it happen a lot. I saw a lot of folks that had bought too many properties and were way over leveraged. That folks that had bought, fancy sports cars and fancy second homes and yachts, and all of a sudden, all of that comes to an end and it all comes crashing down. So, before I was 30, I had the opportunity to see the market go boom and bust, and I learned a lot from it. I'll tell you some of the things I learned. Number one, a 30-year mortgage is a great thing. Let me rephrase: a 30-year fixed rate mortgage is a great thing.
Right.
Adjustable rates can be good for the right people, but can also be dangerous in the wrong hands. And then making a decent down payment. I don't think you have to make, 20%, 30%, 40%, but putting 3, 5, 7, 10% of your own money gives you a lot more emotional investment into that house. And that was something I learned. Is a lot of folks that had put no money down didn't have a big emotional investment. They're like, just give it back to the bank. No big deal. So I learned a lot about being a little more conservative in my finances personally, and then in the advice that I give to clients.
Right. And a lot of people thought that what happened in 2008, 9, and 10 was going to translate into recently 2025, 26, and it hasn't happened.
Mhm.
And for me personally, I don't think it will happen. I think the financing institutions really tied up their processes a lot.
Yep.
Underwriting has become much more stronger. But in general, a lot of people think that's going to happen, and that's probably scare away some buyers, and some people are on the fence trying to
Mhm.
see if things are going to change. They're waiting for that crash, or perhaps for lower rates, which I don't think they're going to come either. But so, what do you think about today's situation in general?
Oh man, you and I, we could have a 2-hour conversation about this. I'll bet, and I bet we're very aligned. I teach a national trends webinar once a month, and we look at national real estate trends and what's happening all over the United States. And there is no indication of a coming foreclosure crisis. Um, Everybody has equity. Pretty much everybody has a job. Everybody that is in a house has been qualified that they can actually make the payments. So folks out there hear it all the time. Oh, I'm waiting for the foreclosure crash and then I'm going to buy something. You're going to wait for a really long time. Now the headlines will say foreclosures doubled from this year, from last year into this year. Foreclosures are up 100%, 80%, 120%. Now that's true, but you're starting from a very, very low base. And the way I describe it is, okay, last year there was 10 foreclosures. This year there's 20. It's kind of like saying yesterday I drank 1 beer. Today I drank 2 beers. Does that make me an alcoholic? Probably not. Right. And it's kind of
Right.
the same thing. If we went from 1 foreclosure to 2 foreclosures, yeah, it's up 100%, but that's not the 1.6 million foreclosures that we had in 2009. So no, I don't think we have a foreclosure crisis coming. None of the data points to it. Do we have lower interest rates coming? Boy, I hope so, but I don't think so. The
I don't think
fundamentals
so
of
either.
our macro economy or our macroeconomic view right now is there's not going to be lower interest rates. If you're waiting for 2, 3%, probably never going to happen. If you're waiting
Well,
for,
we might have sub 6%
we
though.
might have sub
That
six
could
percent.
happen.
Yeah, that could happen. That could happen. But if it's the folks that are saying I'm going to wait for rates to go back to 3% before I buy, I'm like, cool. I have a fantastic property that you should rent right up until that time. Uh, are we going to get below 6%? I do think so. I think that'll probably happen sometime in the next 12 months.
So, quick question: what do you think that, in general, real estate professionals? I'm not talking about specifically, team leaders, agents, do not understand the dynamics of rates and in general lending very good. I do flip houses, so I always have to be on the phone with my agents. Did
Mm-hmm.
you call the lender? Did you ask what is the DTI? Did you ask? And then they never do. Like
They
sometimes they
never
don't
do.
even understand.
Mm-hmm.
And they have some of them. I'm not gonna say otherwise, but some of them have a hard time even explaining that to their clients. Like I am very knowledgeable about mortgage in general because I've been doing this for a long time, but I'm just trying to put myself into the shoes of a 30-year-old couple that are going to buy for the first time. And yes, they have to get some of that information from their mortgage broker. But what about the agents, the team leaders that are dealing with them?
Yeah.
Um,
I'm going to give you kind of a long answer, but I think it'll make sense. I think about a home buyer And let's take them out of buying a home for a minute. Let's say they go to Walmart, and they go to Walmart and they fill up their basket with groceries, and they've got bread and they've got jelly and they've got, steaks and turkey and whatever it is. And they get up to the counter to pay, to the checkout station, and they scan everything in, and the person checking them out or at the self checkout says, "Okay, do you have any money?" And they say, "I don't know. I have no idea. I didn't think about that part." That's that's my job, right? And so what I mean by that is, instead of going to Walmart, they're going out with one of your agents and they're looking at all of these different houses. They find a house that they like, they make an offer, and then the seller is the Walmart checkout person and says, "Do you have any money? How are you going to pay for it?" And they say, "Oh, I don't know." Okay, well, you got to call Joe, or you got to call a version of Joe. You got to call a loan guy and say, "Can I get a loan? Can I get some money to buy this?" And so if you have a good home buyer and a good agent, they've done that step and they have their pre-approval letter before they go out and look at homes. But now you pick out the home, the seller says, "Okay, do you have any money?" And you say, "Yeah, here's my pre-approval letter." Now, what should the listing agent do? The listing agent should then call me, or actually what I do is I call the listing agent and introduce myself. But the listing agent should ask the lender, "Okay, tell me about your pre-approval process," because that's different from one company to the next. Have you verified all their information? Have you looked at their credit report? Have you run this through DU or LP? Do you have an automated approval? Has this already gone through a manual underwriter? Have you not gathered any of the information? Because that happens sometimes. I saw a pre-approval the other day and they had gathered none of the documents. They just said, "We think this is a pretty good guy, so we're going to send you the letter." So, you mentioned you do fix and flips. Your agents should be interviewing the lender. And it's one of my favorite things to do is reach out to the listing agent and say, "Hey, here's who I am. Here's, 10 referrals. Here's my last 5 deals I closed. Here's the addresses of the transactions. We close on an average of 17 days. Please feel free to call any of these listing agents. Please feel free to call any of these buyers agents. What questions can I answer for you?" And if you proactively make that call, there's a much, much higher chance that your buyer is the one that's going to get under contract on that home.
Yeah, and for me particularly, when I see also an online lender, it gives me the chills all
Makes me
the
nervous.
time.
Yeah. And
It makes me
I
very
hate to be
nervous.
mean towards any segment of the market, but I'm in Colorado. 90% of my business is within a 20-mile radius. If I do a crappy job, somebody can come into my office and scream at me in my face. Now, number one, that's never happened because I don't do a crappy job. But if I'm buying a house and I have a guy in Michigan or Connecticut, if something goes wrong, the only thing I can do is call him or email him. People can come to my office and be like, "Joe, you
Oh, good
screwed
luck
this
at them
up."
answering to that email.
Yeah.
It's never gonna happen.
Yeah. But people fall for that. They're like, "Oh, but it's such a great rate." I had one just the other day. Client was working with an online lender. They sent it over to me and they said, "Can you give us a second opinion?" I looked at it and I said, "This is going to cost you $4,000 more when you get to the closing. If you go with us, your closing costs are going to be $4,000 higher. They are also going to charge you that $4,000. They just haven't told you yet." The loan closed yesterday. I called the buyer to follow up and closed with the online lender. The buyer said, "Joe, I don't believe you. We're going to go with them because it's a better quote." Totally respect that. Called him yesterday. "Hey, how was the closing? Did everything go as you intended?" And they said, "It closed okay. But interestingly, the closing costs ended up being $4,000 than we thought. $4,000 more than we thought." I was like, "I know.
I told you so.
The only difference between me and that lender is I tell the truth on day 1. That lender tells the truth on day 29, and you're closing on day 30. So hate to be mean to a certain segment of the market.
Yeah, well, it's not about being mean, but it has happened to me so many times where
Yeah.
online lenders, they do a poor underwriting job, and sometimes one day, sometimes at the closing table, we find out that they're missing something. Like literally has happened to me at least 4 or 5 times where in the last week or at the closing table, they call the title company and say, "Hey, we're missing this, by the way." I'm like, "We're at the closing table. It's 4 p.m."
Yeah.
The buyer is waiting to sign, and I'm waiting to get my money the next day. But yeah, but I guess so. There's a lot of miscommunication, a lot of false information, a lot of, in general, lack of knowledge, I would say. So is that why you became what you're now? Because you wrote a book, by the way. So for the people that don't know, you
Mhm.
wrote a book, and it's all about how to build wealth
Mhm.
through financing, right? So is that why you decided to go that route to
Um,
teach people how to build wealth, how to become more knowledgeable in general about things that could benefit them in the long term?
the open answer to that is no. That's actually not why I wrote the book. This you'll probably laugh. I wrote the book in late 23, early 24. I was pretty bored. I was
Oh,
closing
really?
120, 150 transactions a year, really cruising right along, doing really well. And I had helped a ton of people that had built wealth, built investment properties, and had gotten tons of positive feedback over the years. And I had a lot of spare time on my hands. And I was like, maybe I'll write a book about how to pay off your loan and how to build wealth using your mortgage in your house. And I started recording it, and I recorded an entire video series. It's a 50 video course that I sell online. And the point of this is not to promote that.
No, no,
But
you go right
yeah,
ahead. We don't really care. Just
yeah.
go
But
right
I
ahead.
uh, I recorded a course online, and I started selling it online again because I was kind of bored. And one of my mentors, I asked him to watch the course and tell me what he thought. And he goes, Joe, I think it's great. He goes, you should also turn it into a book. And so I had all of it transcribed. And interestingly, the way you speak is not the same as the way you write. So then I went through every single chapter and rewrote it. It's all my own words, but I had to change it from my written word to
Right.
from my spoken word to my written word. And that's what became the book. That is the Mortgage Escape Plan, which is how you can pay off your loan in 7 to 10 years, not 30 years, without changing your lifestyle. So did I do it because there's a lot of misinformation out in the market? No, I did it because I was bored. But the side effect is there's a lot of
Right.
misinformation out in the market that I'm able to dispel a lot of those myths.
So walk us through the process of how you would do that. I mean, just simplify for us. How would you pay off your mortgage in 7 to 10 years without fully affecting your lifestyle?
Yeah, a couple ways you can do it. Number one is just taking a good open look at where does your money go? How much money are you wasting? And I don't even mean like on Starbucks or not eating out, things like that, but understanding how much money are you wasting on interest. I describe interest as the daily rental fee to own your home, right? You're paying a daily rental fee every single day. Is that being used efficiently? And a really great example is, let's say I get my paycheck and I deposit $5,000 into the bank, and the bank is paying me 0.01% interest. Well, over here, I've got a
Right.
mortgage of $300,000. Well, the bank is charging me 6% interest. What if I would take that $5,000 and apply that over to my mortgage in a way that I could get that money back out when I needed to? But instead of leaving it here sitting idle, what if I put it over here to reduce my mortgage balance? Then in a few weeks, I need to spend some of that money. I draw it back out on my mortgage and I use it to pay my electric bill, to pay my car payment, whatever it might be. But during that time that money was sitting idle, put it over here and pay less interest on my mortgage. And so that's just one good way that you can do that. And you can do that with a home equity line of credit, or with a first position home equity line of credit. The math, when you really understand it, how much the bank is making off of your rental fee, and you're putting your money into the bank, and they're paying you no interest on it. The bank loves the
Right.
way you currently do it. And so I spend time in the book explaining the current banking system, how it works, how it is set up in the bank's favor, not in your favor. So that's how you do it.
This is a tricky question. So let's say you pay off your mortgage, right?
Mhm.
You have a ton of equity in your house. You're in a decent neighborhood. Would you recommend pulling, and let's say you live in that house for 20 years now, right?
Mhm.
So to speak, right? Do you recommend homeowner pulling a line of credit to do renovations and sell that house, or just refinance it as is?
If they're going to sell, I think a line of credit is a great way to do that. It's usually going to have a little bit lower cost, a little bit easier process. But maybe a longer answer is, if you're going to sell, I would look at how much of the renovation is going to cost, and are you going to get that money back? Now, you're an experienced fix and flipper. You can put
Yeah.
$50,000 into a property and probably get $75,000, $80,000 of profit out of it. The average homeowner can't do that. The average homeowner over improves. They put $75,000 into a property and they sell it for only $50,000 more. So honestly, the advice I give to a lot of folks, if you're going to have to renovate your property in order to sell it, you might be better off calling Sergio and just selling it to him at today's value. Let him go through the hassle, the time, energy. He's, yes, going to sell it and make a profit, but for you, Mr. and Mrs. Average Homeowner, that's going to be really difficult. So oftentimes, if folks really want to go through that, I say, hey, go for it. Let me give you a home equity line of credit. But oftentimes they don't get back the money they put in on those renovations.
Right. Okay. All right. Well, I appreciate the answer. Now, I want to jump real quick to some of the biggest myths that you believe are in the mortgage industry. What do you think those are?
Oh, the number one is you have to have 20% to put down. We dispel that myth every single day. I bet I talk to 3 first-time home buyers a week, and they all say the same thing. Boy, I don't have 20% down. I'm just not sure what to do. No problem. Let's talk about 3%. Let's talk about down payment assistance. Let's talk about a gift from mom and dad. That would be the number one myth. Is you do not have to have 20% down to purchase a new home. Number 2 myth I would tell you is self-employed folks. I talk to a lot of self-employed folks and they say, oh, Joe, I can't buy a house because I'm self-employed. Nothing could be further from the truth. Even before non-QM and bank statement loans, I was helping 35% of my clients are self-employed and have been for my whole career. And a lot of folks think I'm self-employed, I can't buy a house. No, you just need to send me your stuff. Let's look at it together. We might be able to make a plan if you don't qualify right now, or you'd be surprised how many folks I can actually get approved just by going through your information. And that's, I think my background on financial analysis early in my career has really helped that.
Does that include 1099 people?
Mm-hmm.
Or not really?
Yeah,
it does.
Yep, I do a lot of loans for folks that receive only 1099s, and that's okay. I can help with that. Show them, hey, based on what you're putting in your taxes, here's what you qualify for. If you want to increase that, talk with your CPA. I'm not a CPA. Here's a couple of tips and things I've seen other folks do. So self-employed folks, I have a great time working with them.
So those are the 2. Now, what do you think? What is the reason why a lot of people focus too much on the interest part of this? Usually when interests are higher, prices are lower. Mm-hmm. Interests are lower, prices skyrocket all the time. So it's a fine balance there. But a lot of people are like, oh, you know what? I do prefer a lower interest, even if the prices are much, much higher, right?
Yeah, and I understand that, right? Because interest is your rental fee that you're paying. And so if I could have something lower, that is going to be better, of course, right? But I think folks get focused on it just because we're trained to. I mean, if you drive down the street, I'll see 5 billboards that say, interest rate on savings is really high. Interest rate on your mortgage with this bank is really low. We focus on it because I think we're a price-focused consumer, as in general in the United States. But I don't think that's the most important thing. I think you should focus on what are your long-term goals. And what I mean by that is, and I'm sure you've seen this floating around on the internet, that interest rates were very high in 1972. And if you waited for rates to go down, you didn't buy a property until 1993. That's 21 years of appreciation that you didn't experience. I'm sure you've seen that quote. And so I try to focus folks on what's your long-term goal. And if today's interest rate is 15%, and this is everything it looks like, does that achieve your long-term goal? Well, good news, today's interest rate's not 15%, it's only 6 or 6.5. Do you still achieve your long-term goal? And maybe you got to say, hey, my long-term goal is this. It only works if interest rates are 2%. Your long-term goal might not be realistic because the odds of getting a 2% interest rate are pretty low. So I really try and focus on where do you want to be in 20 years, and does interest rate make a material impact on that? Oftentimes the answer is no.
Mm-hmm. I mean, we don't have to deny it. The monthly payment, like you said, is the cost to rent the money. It becomes much, much higher, mm-hmm. as interest rates are higher. Maybe that's why they're solely looking at it. So do you think then maybe they should buy a house within their means? I mean, that's what I tell people, right? That, if you cannot afford it because of the interest rates, then maybe you shouldn't buy a $600,000 house. Maybe you should buy a $400,000 house. And that's a difficult conversation to have with your wife and kids. It's like, hey guys, we're not going to move into that cottage that is looking really nice, in a sought after neighborhood. We're probably going to have to live here, right?
That's the answer, right? Because we can't control interest rates. right? And we can't control prices, but we can control what do we pay for a property to put our family into. Um, and maybe it's not a $700,000 home. Maybe it's not a $600,000 home. Maybe it's a $400,000 home. And I mean, I bet you're probably very similar to me. My first home cost, I think it was $180,000.
I
And
rent.
what's that?
I rent.
You
I
rent?
don't
Okay.
even.
Well, let me talk
I
about the
have many
benefits of
houses,
long-term home ownership. I get it. My,
but
my,
I do own a lot of houses. I just
mhm.
rent them out.
Yeah.
But because I move a lot, I never own because I move quite a bit.
So
So
it's funny you said that because I also have rented for the past 4 years. I just bought a home like 2 months ago, but I've owned a lot of rental properties. My very first home paid $180,000 for it, and it was like 540 square feet, but it was my starter home that got me going and got me started in real estate. And I think that's what people forget is we want this immediate gratification of, oh, this $700,000 house, it looks so cool. I really want it, but I need interest rates to be 2%. Well, what if you bought a $400,000 home at 6% today, and 5 years from now, 8 years, 10 years from now, we trade up into that home? Or are you just going to continue to rent for a long period of time? So, and you know what? Sometimes renting is the right thing, right? And again,
right for me it is.
if you'd have had me on here 2 months ago, I was having a ball renting. I just happened to walk into an open house that I really liked, and I was like, "Oh, this is cool. I'll take it." And I could that
Right.
would be a story for a different time. But I think renting is great if you're investing into something else. I think if you're renting and not putting in your money into either the stock market or not putting money into real estate or not finding a long-term investment, I think that can be a problem. But
Yeah.
obviously, you're
Yeah.
investing in other things. Renting is just where you house yourself, but you're putting your money somewhere else that's compounding. I think that's a very
Yeah.
smart.
Plus, my rentals are paying my rent, so it doesn't really
Exactly.
matter. Right.
Yep. Yeah.
To me, it doesn't really matter. But so is that why you think that people should use a mortgage as a financial strategy rather than a debt? Can you explain
Mhm.
that philosophy a little bit more?
Yeah, absolutely. So, something to consider with your mortgage, every single month you make a payment. Let's assume it's a principal and interest payment, pretty rare to have interest only. But every month, let's say your payment is $2,000 and $300 goes towards your principal. Well, guess what? That's a $300 return that you're getting because that money is going into your pocket, right? So you say, "Oh, I'm making a $2,000 payment." Well, only 1,700 of that is going to the bank. 300 of that is going to you. So it's kind of a forced savings, right? Then if I happen to rent that property out, that $300 is still going to me, but who is it coming from? From the tenant. The tenant is giving me that return. And I think a lot of people miss that. The other thing that I think about with a mortgage, it's basically the only inflation protected product available in the United States. Now, what I mean by that, let's say we buy this property and the payment's $2,000 a month today. If we go 10 years down the road, that payment is still $2,000 a month. But 10 years down the road, we've experienced inflation. I've experienced raises. I've gotten promotions. That $2,000 is way less expensive 10 years down the road than it is today. So I can buy a property today with a $2,000 a month payment. And every single month that goes by, that $2,000 actually costs me less because of the power of inflation and the power of my income going up. And I don't think people realize that if you buy that home today, it costs you less and less every single month because less goes towards principal, more goes towards interest. The payment remains the same, but my buying power is higher because of inflation. And I think a lot of people
Yeah, I mean, your mortgage is coming down, house is appreciating, you're making more money, the dollar is worth less in general.
Mhm.
That's that's how I see it essentially. And what are some of the habits of someone that creates wealth? I think we just said that living below your means, it's one
Mhm.
of those. What some other habits that wealth builders have in terms,
Yeah,
and I'm not talking about me or a professional investor, I'm just
just a
talking about in
regular
general,
day to
the
day.
regular folk, day-to-day people that they may have a lot of money from other doctors, lawyers, I mean, whatever you call it, but they're not real estate professionals, right?
Yeah.
What are some of the habits that you have seen in those guys?
The habits that I see are number one, living below your means. We don't have to talk about that anymore. Not driving a big fancy car with a huge car payment. Now, a lot of people, I see folks that have $1 million, $2 million in real estate, and they drive a regular Honda that's like 8 years old. And most important thing, it's paid off, right? Having a paid off car is something that I see for almost an invariable similarity across my real estate investors is they have a paid off car. Now, some of them drive Porsches, like those Porsche SUVs, but it's paid off. Others drive like a Honda CRV, but it's paid off. So having a paid off vehicle, I think, is huge. Saving at least 10% of your income in some vehicle, whether it's the not a car vehicle, but whether it's the stock market, whether it's private equity, whether it's putting money into additional rental properties, saving at least 10% of your money, and then getting that money to go to work for you. There's a chapter in the book about folks that have a 3% mortgage, and they say, well, I don't want to make extra payments because I'm never going to have this cheap of borrowing costs ever again. Okay, completely get that. Instead of making extra payments on your mortgage, why don't you take the money that you could be making as extra payments, put that over here in something that's earning 6, 8, 10, 12%, have that build up a balance. At some point, the balance over here is going to be more than the balance of your mortgage. Now that home, as far as I'm concerned, could be paid off because you could take money from that and write a check to pay it off. I would consider that to be living without a mortgage if your asset balance is greater than your liability balance, and this is earning money faster than you're paying it down over here. So I think that's a big one, is finding alternative ways to have your money make money for you.
Right. Now that you're talking about interest rates, something came to my mind. So let's say you take a mortgage today. Let's say it's 6.57%.
Sure.
Right. What about having a balloon date of like 10 years? So then you have to refinance. Probably rates are going to be lower in 17 years. Would you recommend someone to do it? Doesn't even matter. I mean, whatever balance you have at that point, just refinance it at a lower rate.
Yeah.
Do you recommend people taking a 30-year fixed rate, or just, balloon in 7 to 10 years?
Yeah, I do recommend a 30-year fixed rate. Reason being, a lot of things can change between now and 10 years from now. I'm a pretty conservative financial guy, and I have originated balloon mortgages. I have originated, adjustable rates, loans with prepayment penalties, things like that. Generally, what I've learned is that 10 years feels like a long time, but it can happen very, very rapidly. And a lot can change between now and 10 years from now. So I think a guy like you that is generating commission income, generating, large capital gains from selling flips, absolutely. A balloon mortgage, if it lowers your rate, gets you better terms, I think that's great because you're going to have the means to pay it off. An average teacher, doctor, financial professional, somebody that's on a regular W-2 income, plumber, mechanic, things like that, I wouldn't recommend it, because even though you might feel like, hey, I'm going to save money and then in 10 years I'll be able to pay it off, 10 years will sneak up on you. So I'm a pretty conservative guy, but I also spend a lot of time with my clients because sometimes they're not conservative and they're like, hey, I want this aggressive approach. Fantastic. Let's do it. I just want to make sure you understand the pros and cons.
Right, absolutely. Now, speaking about agents, do you think agents in general what do you think they should do in order to be more knowledgeable about mortgage products? Do you coach agents? Do you think they should attend courses? Well, in general, what are your suggestions there?
Yeah, I do. Number one, I coach agents. I'm an approved CE educator in Colorado. I have a course of 22 mortgage-related courses that I teach that gives 1 hour of CE to real estate agents. I've been doing that for 15, 16, 17 years now. I think that's a very critical piece. One of my classes I teach, I say, hey, I'm going to teach you, it's called Loans from A to Z for real estate agents. I say, I'm going to teach you everything you need to know in 1 hour. I'm going to teach you a couple of questions that the client's going to ask you. I'm going to teach you the answers to those questions. And then the most important thing is I want you to remember at the very end, after you get 2 or 3 questions, you should say, you know what, let's call Joe and talk to him about it. I try to have a really good understanding of the real estate agent mindset and the real estate agent transaction process, but I'm not going to answer more than 1 or 2 really basic questions. When I get to the 3rd question that somebody asks me about the real estate transaction, I say, that's great. Let's call your agent. Let's do a conference call. And I think agents should do the same. They should understand the basics, I think they should probably have a very deep understanding, but they should answer the basics and then say, let's call the loan guy. That, in my experience, creates a real collaborative environment between the agent, the lender, and the client. And I think many agents miss that piece. I think they get the questions and they want to appear smart. They want to be a resource, which I understand. I want to do that too. But I think they then begin Googling or kind of going down the wrong road. Or what I see is they won't ask the lender that's actually doing the deal. They'll call me and say, hey, Joe, we're working with XYZ lender and they're saying A, B, C. Is that right? I'm like, well, there's more to it. If they're saying that, it's probably right. And I'm not working on the transaction. I'm not sure I'm qualified to give you advice. So I see oftentimes the agents won't ask the professional that's involved in the transaction. And I'm not sure why that happens. So I think I would encourage, what should agents do? I definitely think CE is great, mortgage education, and then collaborating with your mortgage lender and collaborating with the mortgage lender that's working with the client.
Do you believe they're missing a lot of opportunities in general, agents, for not educating themselves enough?
I do. I think agents miss out on helping their clients get the best possible transaction. Yeah, I do think that. I don't think it happens all the time, but I have seen it happen.
Yeah, absolutely. No, I totally agree. And I've seen it first line, so I'm with you in that from. So you're running the team right now, if I understood correctly. Right. How's that going?
I love it. I do my own individual production. I have a team of 4 loan officers that work for me right here in Colorado. I have another team that's in San Antonio, Texas. They're doing fantastic. I really enjoy it. I enjoy coaching my team. I enjoy talking with them when deals are running well, when deals are not running well, whatever it might be. I just super enjoy it. I enjoy the coaching, the training. It allows me to see more transactions than I could do on my own individual basis. And I think, you see little hiccups and I'm like, oh, I remember when I made that hiccup back in 2006. Here's how I fixed it, right? And I lost sleep over this type of deal in 2012. Here's how I got over that. So it's a lot of fun to see some of those same things that keep occurring. And I can go back and be like, wait, how did we solve that? Let's go back and look. I actually have every file I've ever closed. So I have, everything in a secure folder that I can go back and look. Oh yeah, we had this guy that was self-employed and had this weird distribution income. Let's go back and look at it. Oh yeah, here's how we did it. I enjoy it a lot. Putting together the transactions and helping, team members is a really fun part of what I do.
Are you going larger?
I don't know. I would be open to hiring more people, but I like to have the right people. I'm not trying to have a team of 100 people where things are scattered. The 10, 12 folks that work with me, we very much vibe, I guess is the word I would use, that we get along really well and we're all focused on goals. We're focused on providing a great experience. And I think that's true for most people. But we just have a really good, I don't want to say family because I hate when people say that. We're like a family. We're like a,
I say that all the time.
We're like a team.
I'm like, hey guys, we're not a family.
No, we're
family
a
is
team.
when you live the workplace, you go home, your kid, your wife, that's your family. Here, we're a team. Yeah, we're a cohesive team and we help each other and we go out sometimes. We're not a family. That's right. Too cliche for me.
I agree. Like we're a team. And sometimes teams are going to win, sometimes teams are going to lose, but we're all in it together.
Yeah, absolutely. So how's been delegation for you? Have you struggled there?
Not lately. I had one of my mentors gave me a talking to. This would have been in 2010. I was closing at the time 65, 70 transactions a year, just doing it all by myself, just with a processor. And he sat me down and he said, Joe, you are really screwing up. And I was like, how am I screwing up, man? I'm closing 65 deals a year. I feel like I'm killing it. My W-2 is great. My wife is happy. Like, what's the problem? And he broke it down for me. He said, you're spending way too much time, way too much energy. You're missing this call. You're missing this new lead. And he really broke it down for me. And he said, you are fouling up by not having somebody who can do it 85% as good as you. And that really stuck with me. And I hired my first team member. And at first, she took a lot of training, took a lot of coaching to get her up. And all of a sudden, something switched and she was crushing it. And she could do stuff just as good as me. She could handle all the sections of the transaction that I assigned to her. And my volume doubled the next year. I did like 140 transactions the next year just by adding one team member. And so that really taught me the power of breaking down the process of what happens, what is the next step, what is the next step, what is the next step, and having a flow chart and a process. So now we have a flow chart that from the time the phone rings until that loan is sold, here is every single step, who does that step, how do they hand it off to the next person. And so that delegation piece now is really easy. And I think this is something that a lot of loan officers struggle with is we can do all of the steps, but we often jump around and make it, kind of helter skelter. If you can take the time to break it down A to Z and then teach your team how to do A to Z, holy cow, your income will go through the roof.
So do you spend a lot of time still in the trenches, or you're trying to go more macro right now?
50-50. I really enjoy, I never want to not be in the trenches because I love talking to people. I really enjoy a first-time buyer, somebody who's buying their first investment property, a first-time seller who's, trading up for the first time. I enjoy those conversations a lot. So I never want to get out of that. But the other 50% of the time is teaching my team how to follow that process, right? And sometimes they'll be just like other loan officers where they're skipping around helter skelter, and I got to slow them down, be like, hold on, you're working on step R and you missed step K way back here. And that's where this problem comes from. So slow down and follow the checklist. And that's something that'll probably always be there if I had to guess.
Yeah, absolutely. So, what's the future of your personal brand right now? Are you trying to be more out there, build more personal brand around you, perhaps build your companies around your personal brand more and whatnot?
Yeah. So my personal brand is I'm really smart and I do a good job, and that's something that I focus on. I recently wrote another book, how real estate
Oh,
agents can
nice.
succeed with AI, and so I teach a class around that. It's actually one of my new CE courses that I'm teaching real estate agents how to use AI, and not in a super high level way. Not in you have to become an AI expert, like very simple things that you can do with AI. And I'll give you just a real quick one. If you're a listing agent and I'm a buyer's agent, I can go to ChatGPT and say, okay, I want to make an offer on 123 Main Street. I'm representing the buyer. I want you to research the listing agent. Here's the address of the property. Here's the listing agent's Facebook link. Here's the Zillow link. Here's their profile on LinkedIn. Please research them. Give me a disc profile on how they like to negotiate and what are the ways that I can interact with them to have the best opportunity for a collaborative experience and still negotiate in a positive manner for my client. It'll take about 2 minutes and it'll come back and give you a full personality profile on the listing agent. How powerful now am I that I can match and mirror their disc profile when I'm calling and negotiating with them?
Isn't
So
that scary?
yeah, it's great. So I teach an hour-long class on things like that are just quick little tidbits. So that's where I'm going. Is I like to think I'm smart, and I like to give out really good knowledge and information. And then I just ask everybody, when you think mortgage, I want you to think Joe Massey and give me a call. I would love to work with you or your clients.
What are some of the AI that you're using right now? I'm using Manus, I'm using Claude, of
Mm-hmm.
course, ChatGPT. I was looking forward to that Anthropic AI that got shut down by the government.
Yeah,
But I was really looking forward into that one too. I mean, the
yeah.
things you can do, it's crazy.
Oh, it's wild. Yeah. So my favorite. This is 2 years ago, I would have been, a leading thought leader on this, but now I'm like behind the times. My favorite is still ChatGPT. I
Still,
use it for everything. I use it for interior design. I use it for brainstorming. And then we have an internal system called SynerGPT, which is built on the backbone of ChatGPT and Claude. And that is great. So for mortgage loan officers out there, you want to make sure that your company is using some sort of AI. And I'll give you a great example. Clients upload pay stubs, bank statements, all sorts of different items. They're always disorganized. It's about an hour-long process for a loan officer assistant to go through and organize, rename the files, put them in the right place. We can now take the entire upload from the client, put that into SynerGPT, and say, hey, please organize this. It'll then read all of the PDFs, put them all in the right order, spit them back out in less than 2 minutes. Okay, here's your income, here's your assets, here's your credit report, here's your letter of explanation, and they're all organized that then we can put those right into our loan origination software. So that's something that used to take an hour for an LOA. Now it's less than 2 minutes for AI to do it.
It's crazy. I mean,
Mm-hmm.
2 minutes.
Yeah, so that's 58.
So that means that
just got back from the
LOAs,
transaction.
LOAs or in general, LOs will be able to double or triple their production easily.
That's exactly
with
what
AI.
I think. I think LOs will be able to double or triple their production with the same employee headcount. And I think agents are going to do the same thing. I think agents that embrace it and take your flow chart, right? Go from A to Z. What are the steps that we can have AI do? And then I can take that LOA's time and allocate it to something else that's going to help generate business. Agents can do the exact same thing. Take your flow chart. What am I doing? What is my transaction coordinator doing? What is my showing agent doing? What are the steps I can automate? And then how can I reallocate that time into more prospecting?
Now, so based on that, do you believe that in the future we're going to have less LOs, less agents, because there are going to be some agents that are going to be, because right now as it is, I mean, the big portion of the agents do not sell one single house
Mm-hmm.
in any year, right? And some of them are anywhere between 1 to 5 houses a year,
Mm-hmm.
and there's a very small portion of the agents are succeeding, right? We believe is the opposite, but it's not. I mean, it's the majority of agents do not sell any houses or very few houses.
Yep.
I don't know if it's the same case with LOs,
It is.
but it is. Okay,
Mhm.
so are we thinking or the same? Are we going to have less LOs, less agents in the next 5, 10, 15 years? Because the ones that are producing are going to produce even more.
I'm going to give you a two-part answer. I completely agree with that theory that more people or fewer people are going to do more transactions. Therefore, this bottom segment is going to leave the industry. Common thinking, I completely agree with that. But my actual answer is I disagree with that. I think the bottom segment is going to remain because of the fact that commissions have gone up so much that you only have to do one deal like every 3 years for an agent in order for the license to pay for itself, right? Because an average commission used to be in Colorado used to be about $4,000. Now the average commission is upwards of like $16,000. The cost to get
Right.
licensed is only about $2,000. The cost to keep your license is only about $1,000, right? So if I can do a deal once every 3 years, it still pays for itself. So I don't think we're going to see as many people getting out of the industry because commissions on a per deal basis have gone up so much. But I think the old 80-20 rule of 20% of the agents are going to do 80% of the business, that's going to get worse. I think it's going to become the 90-10 rule. 10% of the agents are going to do 90% of the business. And it's going to be important for loan officers to embrace that and make sure you're talking to the 10% of agents that are doing deals.
Okay. Okay. Well, I never thought about that. I mean, yeah, in general, appreciation is making commissions go higher, but I was always thinking what's going to happen with the ones that only sell one house every so often. Are
It's
those going to get scooped by the agents that are producing more? But we'll have to see.
Yes, and I think that's going to happen, right? More of it is going to go towards the higher producing agents, but the folks that do a deal, maybe they used to do one deal a year. Now they're going to do one deal every 3 years, but they're still going to keep their license. So I don't think you're going to see a drastic reduction in agent count, but the difference from the bottom section of the agents to the top section of the agents is going to become bigger. The bell curve is going to be skewed more towards the higher producing agents.
Okay. Okay. Fair enough. All right. So I have this section. It's called rapid fire questions.
Yeah.
Just one simple answer. You don't have to overthink it. So one financial book everyone should read.
The Psychology of Money. I read that on vacation last year. Really enjoyed it.
There you go. Biggest mistake first time home buyers make.
Um, Waiting too long to buy. I do think you should buy sooner in your 20s, but don't buy above your means.
Okay. Fair enough. One financial habit everyone should build or have.
Ooh, I wrote this down earlier because I knew I was going to have a good one on this. Live below your means. But I've already answered that like 3 times. So let me give you a different one. Buy sooner and buy more often. I think,
Buy sooner and buy more often.
yeah, I think waiting for the perfect time is a false prophecy.
Okay, so do you one AI tool professionals should start learning about? I think you said
Chat
ChatGPT is
GPT.
fine,
Yep.
but do you believe
It's an
AI
assistant
is
that
going?
has a PhD in everything, is what I always say.
That's true. One AI. Do you think AI is going to replace agents and LOs in the future?
No. And I'll tell you why. People still want to have their hand held. There was a survey by NAR of first time home buyers last year, and they said, "Do you want your lender to have an online portal that makes it easy for you to apply and upload your documents?" And 97% of people said yes. Follow up question: do you want human interaction with your lender to make sure you're getting the best possible rate, term, and details of your transaction? 87% said yes. So 80%, 87% of home buyers last year said yes, they still want a loan officer to guide them and make sure that they're getting good human interaction. So I don't think AI is going to replace us yet.
Yeah, because we're derailing a little bit, but I want to say that I think it's an adoption thing, right? So
Yeah.
every new technology goes through an adoption period, and AI may have a longer adoption period. We don't know yet, obviously, because when we talk about ChatGPT, Manus Claude, and whatever other AI is out there, every time I talk to people, the big majority of people don't know what it is or don't know how to use it.
Mm-hmm.
As opposed to, for example, when the first cell phone came, the adoption period was very short. You know, in 5 to 10 years, everyone was having and using cell phones. So I think the technology varies a lot, and the adoption time therefore also varies a lot. It depends on how impactful the technology might be, and if it's too impactful, it's going to take longer for people to adopt it. So I think I don't know if it's going to fully replace AI. AI is going to fully replace agents and LOs, but I don't know. I mean, 40 years might be a different story.
Yeah.
You don't even know if you're interacting with a human or not. You know,
That's right.
What's going to
That's
look
right.
like in 40 years.
Yeah. So my answer: we should do this again in like 2 years. You know, and I'll be out of work. I'll be an unemployed loan
I'll
officer.
take your
I'll be
word.
like, oh, so yeah, I guess AI replaced my job, right? But
All right. So
I
the
don't think
last
it's going to
one.
happen immediately.
No, I don't think it's going to happen immediately either. So the biggest opportunity in real estate right now.
I think there's great deals for buyers right now. I am seeing buyers get away with outstanding seller concessions. They can ask for a lot on repairs. They can ask for price concessions. I think the biggest opportunity, if I were thinking about buying a home right now, is I would go to the MLS and I would look at everything that had been listed for greater than 90 days. And I think there's tons of opportunities out there. I would put down at least 10%, and I would get 6% seller concessions so that I could get a 2-1 buy down and buy down my interest rate well into the fives. I would negotiate for lower price, and I would buy that home and live in it for the next 10 years. I think there is a ton of opportunities on the buy side right now, and I don't think we talk about it enough. We've been in the seller's market from really 2012 until roughly 2024.
2025.
Yeah, 25, depending on where you're at in the country. And sellers don't really know what to do when they have to operate in a balanced market. And you can really get away with asking for a lot right now. And I think buyers are not taking advantage nearly as much as they should be.
Yeah, absolutely. And of course, like you said, it's real estate is very focalized, it's very localized. So your market may not be experiencing what we're describing right now. It may be super hot, but in a lot of markets, it's not the case, right?
Yeah.
So fantastic. So my team wrote a million. We would call it $1 million question, but I'm going to rephrase it because I think if I do it in the same way they put it here, it's going to go back to some of the things that we discussed. So I'm going to change it a little bit now. If every loan officer that is watching this show or that is going to watch the show, let's say you're starting tomorrow from scratch. You don't have a brand, you don't have a business, and you want to be a loan officer, a successful one. What are the things that you would do in today's market?
If I want to be a successful loan officer starting from scratch, I would start calling every single real estate agent and asking if I could interview them. I would call every single successful real estate agent and say, I want to build a playbook for what works in this market, and I would really like to spend 30 minutes to interview you. And once I've compiled all of the best ideas, would you be open if I shared that with you? I would just start interviewing people, finding out what works in my market, and then I would give that back as an item of value to them. And then, if this was useful information, don't forget to call me for your mortgage needs.
That's a solid answer right there. Appreciate it, Joe.
Thank you.
Thank you for your time.
Yeah, I really enjoyed it. Thanks so much for having me on.
We did super great. Well, thank you for your time. I'll see you in 2 years.
Look forward to
I'll
it.
take your word for granted.
I hope I'm still employed.
Thank you, man. Appreciate it.
Thank you. We'll see you soon.
Joe, thank you for sharing your knowledge and your passion for helping people build lasting financial freedom. This conversation reminded us that real estate isn't just about buying and selling homes. It's about making decisions today that create opportunities for years to come. And to everyone listening, if you found value in today's conversation, make sure to follow, like, share, and leave a comment. Until next time, keep learning, keep growing, and keep cracking the code.